Have you ever wondered what is the single most important question that stock market investors ask themselves? It is, of course, whether to buy or sell. As graduate business students, we have also made an investment to optimize our expected future incomes. In short, we are all here to make money and as much as possible. Hi, I'm Mayank. With Dennis and Shiva as a team, we decided to tackle this investment question by using tools learned in the WebData Analytics course. We will provide a quantitative approach useful to amateur investors who lack access to sophisticated financial packages. The resulting analysis provides a well rounded understanding of descriptive as well as predictive information of stocks. As an example, we used a diversified portfolio of four stocks which encompasses four different companies, namely Apple, GE, Royal Gold, which is an international gold mining company and reflects the behavioral trends of gold, and lastly, Verizon. For this analysis, we scraped historical stock price information from Yahoo Finance using R Studio. First, we plotted average price of stocks over the years and we found that gold prices act as a counter-cyclical factor to stock market uncertainty. Investors believe that under economic uncertainty, the price of gold would hold its value against fluctuating assets. Interestingly, during the economic recession period around year 2008, Royal Gold stock prices were on an average higher than the other stocks. Then we plotted the value of $1 invested in February 2008 over the following years. And we observed that Royal Gold stock has a higher median return with a low variability, whereas Apple also has a higher median of return but has a high variability in prices. Verizon and GE perform rather conservatively compared with these two stocks. Running correlations between stock prices, we found that there is a relevant correlation between Verizon, GE, and Apple. Royal Gold has not much correlation with the other three stocks, indicating that its stock price is affected by economic factors in a different way. Now, we'll show the predictive analysis of these stocks using Brownian motion. Oh, I said brownie, not Brownian. Biologist Robert Brown observed in 1827 the jittery motions of particles floating in water. If you observe it clearly, this motion is same as how stock market behaves. Stock prices are driven by speculation. When the market is open, prices can even change within fractions of seconds. Louis Bachelier then created a mathematical model to account for these variations. Brownian motion is often compounded with a Monte Carlo simulation. This is a framework to predict future outcome many times over. The resultant trend line fit between trials can be analyzed. Given the speed of current stock market transactions, experts believe this assumption to be sound. This simulation accounts for important variables in the financial markets such as beta. It is a measure of stock's volatility throughout time in comparison to the S&P 500 index denoted with capital E. Moreover, nu indicates the percent change of a stock throughout a specific period of time. But applying this simulation was not that easy. We had to deal with a complex Python code to generate. To generate the results of our simulations, we ran 25 iterations for each company, which is shown with the for loop in the code. Interestingly, the results of our simulation are an accurate reflection of current uncertain economic conditions in the United States. Some industries are more susceptible to volatility than others given individual industry conditions. Apple and Verizon show moderate negative trends while GE is showing a steep negative trend. As a result, our recommendation to an investor would be to sell its positions in Apple, GE, and Verizon and to use that money to buy stocks in Royal Gold, which shows a clear increasing trend in the future years. However, using a Brownian model for predicting future stock behavior has limitations. It cannot predict major shakes in the economy such as war, natural disasters, or fiscal policy reviews. Therefore, Brownian motion is mostly useful for short term decisions, like for 1 year or 2 years. To conclude our video, in a world where anything can happen, this type of model shows a rational approach to which beginner investors can add qualitative analysis of macroeconomic trends to optimize an investment strategy. We hope that you all enjoyed our video. Now it is time for you to invest in stocks and make some serious return on investments.